This wasn't a bank run in the traditional sense. It was a coordination failure. And coordination failures don't just happen in banking. The answer is more fragile than you'd think. It's not about size. It's not about how much debt exists. It's about timing. In practice, with real numbers. Let's start with something simple. Imagine a chain of 5 companies. Company C uses that money to pay Company D, who's been waiting on an invoice. Company D pays Company E, who then pays their own suppliers. This happens constantly. Trillions of dollars move through chains like this every single day. Most of it invisible, most of it automated. Now, here's the catch. None of these companies are holding much cash. Not by much, just a few days late. Maybe they're waiting on a client. Maybe there's a paperwork issue. Doesn't matter. Company B was counting on that money to pay A. Company C, but now they can't. So Company B delays their payment by a few days too. Company C was counting on that money to pay Company D, but now they're short, so they delay. You see where this is going. And here's the kicker. Company E might have been planning to pay Company A at the end of this cycle. This is called a liquidity cascade, and it doesn't require anyone to be insolvent. Everyone might have assets. Everyone might be profitable on paper, but if cash doesn't move when it's supposed to, the system jams. Now, let's zoom out. In the real world, these chains aren't 5 companies, they're 50. Or 500. And they're not just linked in a straight line. They're linked in webs. Company B might owe money to 10 different companies. Company D might be owed money by 20. But if one payment is missed, if one deal falls through, suddenly the company can't make payroll or pay suppliers. This is what happened to Bear Stearns in 2008. The firm had $18 billion in cash, but it owed $200 billion in short-term liabilities. $18 billion in cash, gone in 4 days. The overnight lending market, where banks lend to each other for 24 hours at a time, suddenly spiked. Interest rates, that are normally around 2%, shot up to 10% in a single afternoon. Why? Because one or two large institutions needed cash and couldn't get it through normal channels. So they bid up the price, which made other banks nervous, which made them hoard cash, which made the shortage worse. The Federal Reserve had to step in and inject $75 billion in same-day liquidity to calm things down. Nobody went bankrupt. No major institution failed. But for a few hours, the system was seizing up. All because a handful of payments didn't land when they were supposed to. Let's look at something more recent. Evergrande, the Chinese property developer, defaulted on a bond payment in 2021. The payment was $83 million. Not a huge number for a company with $300 billion in liabilities. But it was the first domino, because Evergrande owed money to suppliers, contractors, banks, and bondholders all over China. When they missed that payment, everyone downstream panicked. Contractors stopped working. Suppliers demanded payment upfront. Banks froze credit lines. Within weeks, construction projects across China ground to a halt. Not because the projects were unprofitable, but because nobody trusted the payment chain anymore. The Chinese government eventually had to step in with coordinated bailouts, not to save Evergrande, but to keep the entire real estate sector from collapsing. One missed payment, hundreds of billions in frozen capital. Here's what makes this worse. The system is faster now than it's ever been. Payments that used to take days now take seconds. Trades that used to require phone calls now happen algorithmically, which means when something breaks, it breaks faster. In 1987, the stock market crashed over the course of a day. In 2010, the flash crash happened in minutes. Algorithms detected a problem, started selling, triggered more algorithms, and within 20 minutes, $1 trillion in market value evaporated. It came back. But the point is, the system doesn't give you time to think anymore. When payments stop, when liquidity dries up, institutions have seconds to decide whether to lend, hoard, or sell. And most of them choose the safest option, freeze, which jams the system even faster. Here's the absurd part. The more we try to make the system efficient, the more fragile we make it. Central banks encourage low interest rates, which encourages borrowing, which encourages companies to hold less cash. Regulators push for faster payment systems, which makes everything more interconnected. Investors reward companies that maximize returns, which means minimizing idle reserves. Every optimization makes sense on its own, but taken together, they create a system where a single missed payment can propagate across the entire network in hours. And the more complex the system gets, the harder it is to predict where the next break will happen. Nobody expected Lehman to collapse. Nobody expected Silicon Valley Bank to fail. Nobody expected the repo market to freeze in 2019. But in hindsight, all of them followed the same pattern. A missed payment, a liquidity crunch, a coordination failure. So, what's the solution? Well, central banks have become the default answer. When liquidity dries up, central banks inject cash. When payments freeze, they guarantee loans. When the system jams, they act as the lender of last resort. This works most of the time, but it creates a different problem. Moral hazard. If companies know the central bank will step in, they have less incentive to hold cash reserves. They can take more risk, borrow more, optimize more, because they assume someone will bail them out, which makes the system even more fragile. The Federal Reserve's balance sheet has grown from $800 billion in 2007 to over $8 trillion today. Much of that is from emergency interventions. And every time they intervene, the implicit message is, "Don't worry, we'll catch you," which means the next time, the fall might be even bigger. So here's where we are. We've built a financial system that depends on perfect timing. Every payment has to land when it's supposed to. Every loan has to roll over. Every counterparty has to fulfill their obligations. And when that doesn't happen, the jam spreads faster than anyone can react. You can call it efficient. You can call it modern. You can call it optimized. But you can't call it stable. Because stability requires buffers. It requires slack. It requires the ability to absorb a missed payment without the whole thing unraveling. And we've spent decades removing that slack. So the question isn't if the next jam will happen, it's where, and whether anyone will be ready when it does. Because the system has a design flaw, and the flaw is baked in.